Hey everyone, it's Rico Baird, realtor with Preapproval Real Estate Group, and today I'm here with Jon Chan from RBC again. We're continuing our series, our mortgage-related series, and today we are going to be talking about interest rates. So we just wanted to break down interest rates in the simplest way that we possibly could, separating between what's a fixed interest rate, what is a variable interest rate, pros and cons, and then kind of finishing off with information on pre-approvals and how you can benefit from rate holds. So before we get into all that, I will let Jon introduce himself.
Yeah, again, Jon from RBC Royal Bank. Always happy to provide advice to our clients when, again, looking to borrow to meet their financial goals.
Awesome. Thanks, Jon. So I'm super excited for this one, and it's just going to be a simple Q&A. So why don't we just start off with what is a fixed interest rate?
Yeah, a fixed interest rate is a type of term that protects you for whether it be 1 to 5 years, for example, on the interest cost on your mortgage plan. So it's pretty much your set it and forget it type of mortgage. You're guaranteed for the next 5 years. You know what your payments are. You know what your expected balance and maturity looks like. And many clients do take that because they want the confidence to know that's one less thing to worry about.
Right, just stays the same. And then, so in contrast to that, the other option is a variable interest rate. So what is a variable interest rate and how does that differ from a fixed rate?
Yeah, absolutely. The variable rates compared to a fixed rate moves with the market based on the Bank of Canada. This can be good when rates are going down. It can be the opposite, of course, when rates are going up. But traditionally, variable rates can be better over the long haul, but it can also be a roller coaster ride to some folks. So it really depends on your take on risk and change over the course of your mortgage.
Right. And so I think like a misconception or a way that a lot of people see variable rates is obviously, you know, the interest rate is an extra interest charge on top of what you're borrowing. But I think some people view it as, oh, if I have a variable interest rate and the prime rate goes down, then my payment also goes down. But I don't think that's necessarily the case.
You're right. Most lenders, they'll keep the payment itself, the principal and interest amount, static for the term. So it's pretty much, you know, what you're signing up for at the beginning of the mortgage. Now, as mentioned with the fixed rates, that's going to be consistent over the next, again, 1 to 5 years, for example. With a variable mortgage, on the other hand, if there's changes to the rates up or down, the interest portion of your payment changes. So, for example, if interest rates go down, but your overall payment stays the same, you're going to be paying off your mortgage faster because more of it's going down to pay off what you borrow.
Right.
On the other hand, if interest rates go up, then, and with your payment staying exactly the same, less is going to principal, so taking you longer to pay off your mortgage. So ultimately, that effect, overall effect, is still the positive or negative if interest rates change. So we certainly advise our clients that do have variable mortgages to really keep an eye on things,
Right.
and then we can make adjustments accordingly. If, again, interest rates do go up, you want to be possibly paying a little bit more just to keep up with the Joneses, just in case.
Right. So for both of them then, in most situations, for a fixed and a variable interest rate, the payment that you make is for the most part always going to be the same, but the only risk is that for variable, there might be a larger portion of that going to interest if interest rates go up. Is that right?
That's right. So again, payments themselves typically stay the same throughout the course of the term. The one thing I want to mention about variable rates, though, there is what they call a triggering interest rate, which means if it increases to the point where the payment, the overall payment, is not enough to cover the interest as a whole, that's when we have to reevaluate what the payment looks like.
That must be pretty drastic.
It is. It is. We obviously, it's, for example, it might be almost double, or it'd be, no, I wouldn't say that, but like a considerable amount over what.
Significantly higher.
But it can, in theory, happen, and that's why we want to keep an eye on things. So, for example, you're paying a fixed amount every single month, and interest rates keep creeping up multiple times, and then suddenly, if you take that payment and realize, oh, that's not even enough to cover the interest,
Right.
then certainly needing to make adjustments. There would be a lot of indications, of course, leading up to that, but certainly talk to your advisor to make sure you're on top of things, especially with having a variable mortgage.
Right, cool. So just kind of a recap, going back to the fixed rate, can we just talk about the pros and cons of the fixed rate just to sum that up? So starting with the pros.
Yeah, pros again, it's that set it and forget it mentality. You have that peace of mind knowing that the rate you have is solid for the next whatever term you took. You don't have to worry about all the noise in the market, and typically having a stable payment and expected outstanding balance at the end of the term. The
Mm-hmm.
con, on the other hand, typically speaking, fixed rates, you pay a slight premium on interest rates over, say, a variable term, basically for that guaranteed notion that this is my payment. So
Mm-hmm.
you're effectively paying a little bit more usually. And in that case too, if rates are lower as a variable term or a different fixed term, you might be pegged at a higher rate for the next whatever years. And to switch over may incur a penalty because you've committed for 1, 2, 3, 4, or 5 years.
Right. So for anybody that is in a term for say 3 years or whatever, if the interest rate ends up going down during that 3-year term, your interest is still staying at that higher rate that you had fixed in.
That's right. So it can be a double-edged sword where if rates are on the rise, you'll be sitting back and laughing because, hey, I'm at a lower rate. I don't
Right.
have to worry about what's going on in the world. But on the other hand, if rates are dropping below what you have, you're going to be thinking, hey, am I missing out something here?
Mm-hmm.
Uh, Again, it's not for everyone, but more people do typically like that set and forget it notion. You have more important things to worry about than your mortgage, and our job is to provide that advice and take that stress off your shoulders, so you don't have to worry about what your payments look like or what your outstanding balance will be at the end of the term.
Yeah, and I think that what you said is so true. Like if you are going to choose a variable rate, it's better to, be more aware and make sure that you're one of those people that is maybe in the market or paying a little bit more attention. Where, as I also see that a lot of people like the fixed rate just because it's, I would say you have to pay less attention to it, maybe a little bit more risk averse. So,
No, and absolutely. I mean, everybody should have some awareness of what you're doing. I mean, it's certainly a big undertaking to have a mortgage, buy a home.
yeah.
So you owe it to yourself to have some attention and listen to your advisor to get some good advice around your plan. But with variable mortgage, probably that little extra attention that's needed in case things happen. You wouldn't want to necessarily stress out too much if you hear a lot of noise in the market, but that shows you the type of personality as well that's needed to have a variable mortgage.
Yeah.
Because if you do get caught up in the noise in the news, maybe being stressed out by that shows that you weren't necessarily the right fit for a variable mortgage, perhaps.
Yeah, no, that's a super good point. Is I think that a lot of people just see interest rates as like what number is lower, but it's also a very personal choice, and there's pros and cons to each, strictly based on your personality. So that's a
Mhm.
really good point. Moving on to the variable, I mean, I think we've kind of already gone over it, but just really quickly, like what are the pros and what are the cons of the variable rate in your opinion?
Yeah, mentioning before, the pros of variable mortgage, typically you're paying less compared to a comparable fixed term. So for example, a 5-year variable versus a 5-year fixed, the variable is typically lower because again, a number of factors as well as being linked to the Bank of Canada's prime rate. That gives you the added benefit that if rates drop, you'll immediately see the benefit there. Again, your payment may not change, but you'll be owing less on your mortgage overall. So the net effect is saving on your mortgage, saving on interest. That's
Right.
a fantastic benefit. The con, as also mentioned, is having the opposite effect. If Bank of Canada decides to raise the rates, you'll immediately feel the impact to your mortgage. That knowing that it'll take you longer to pay off your mortgage since your payment doesn't change, and having that potential uncertainty depending on where the market is, the overall economy, and we're seeing that right now. There's a lot of uncertainty with obviously rates changing like the way they have been over the last while. They will rebound, so there is some conversation to have with an advisor to say, is variable worth it right now versus taking that something that's set and guaranteed right now as well. So definitely see what works for you as a borrower, because everyone's different. So I have a lot of clients that, let's just be honest, chase the lowest interest rate, but might not be the right way to go, because there's a lot beyond the interest rate in terms of what is the type of personality perhaps that it takes to have such a mortgage. And are you risk adverse? Would you rather be just hands off versus, hey, you know what? I'm willing to take that extra attention, which, rightfully so. But again, needing that little extra tough skin to not be worried every single time there's an economic report coming out.
Right.
So I'm worried about my mortgage now.
I think too, something that I want you to touch on just briefly is a lot of people, what are they Googling or what are they searching or what are they asking us? It's like, which one's better, a fixed or a variable rate? And I think that, when you're looking for that answer through articles, a lot of the time it's not relevant to today's market, or that article might be outdated. And with variable rates, so many things are time sensitive. Like we were just talking off camera about how, a couple years ago, the fixed rates were actually below the variable rates. And it's not always the case, even though in most markets, it is going to be that the variable is below the fixed and you're paying a premium for that fixed guarantee. But I think that that's a really important reason to talk to somebody and get relevant and immediate information and not outdated information.
Absolutely. Because everybody's situation is different. I have some people that are asking for the best offers now because they're looking at buying something that's happening now within the next few months. Whereas maybe compared to, potentially a friend is also buying, but maybe they're buying a pre-sale that's not ready for a few years. Well, the interest rates we'll be talking to that individual would be something applicable a few years from now. Right. And that's a whole other conversation, obviously, about builder approvals, builder rates. But the point I want to get across is everyone's different, and to not necessarily focus on, hey, I heard that this was the best offer out there. Well, maybe ask the question, does it even apply to you? Is it even relevant? Because sure, interest rates look more attractive today, but they may not be valid for someone that's buying something 2 years from now, because interest rates are typically only good for 90 to 120 days. And quoting that for someone that's buying something down the line means nothing.
Right. So, segueing into the next thing here is talking about pre-approvals, right? So for all of those people that are out there looking to purchase, most of them are talking to a mortgage broker in advance, getting that pre-approval so that they understand their affordability before they purchase, obviously. And one of the benefits of a pre-approval is, of course, locking in your interest rate, as you said, for usually 90 to 120 days. So, I get the question a lot. It's like, let's say the interest rate is, X amount today. If that interest rate ends up going up, then the benefit of that rate hold is that you're still locked into the lower amount that you were locked into before. But a lot of people ask me the question, what happens when the interest rate goes down closer to my completion date and I'm pre-approved and I have a rate hold set? So what happens in that situation?
Yeah, we certainly want to go to bat for our clients that had the foresight of getting a pre-approval up front and respecting that. Let's just be honest, things can change between the time we initially talk to a client to the time that their purchase is finalizing. So we'll certainly look to adjust the overall offers and rates if they go down, just so that make sure the client gets the best advice, best service, best options available. You already mentioned the kind of the obvious, if interest rates go up, well, that doesn't matter because we're solid at set amount in our pre-approval. But if it goes down, we have multiple mechanisms within RBC to adjust plans, adjust everything for our clients so that they know that they're getting the best options available rather than needing to ask again. If that's something that clients will have to think, do I have to just start this whole process all over again? It's like, well, not necessarily. We were willing to set up a pre-approval early on, and which is again typically good for 90 to 120 days. And if completing something within that time frame and rates go down, we'll look to adjust that for our clients. So we certainly want to have an open dialogue with our clients to say, hey, look, you're going to get the best offer available that you deserve.
So is there like an end date for when you can change the interest rate if the interest rate has gone down prior to completion?
Well, like I said, there's a couple of different mechanisms in place. if what we call the base rates change between the time of, frankly, the firm approval stage to the actual funding, they'll automatically adjust right up to the day that the mortgage goes funds. That means even if the papers have all been printed at showing that the interest rates are at a certain amount, behind the scenes, everything will adjust at funding. So you'll get the lesser of the two.
So pretty much right up until completion in that.
Yeah, basically speaking. Ideally, we make as many changes as we can before issuing all the instructions, because most people feel more comfortable signing what they believe will be the case. But just to know that if the posted rates do change even after that point, that will adjust between the time, well, frankly, right up to time of funding. And it's just what we call a float down at RBC. Just a great way to show additional benefit to know that, hey, I saw this happen. Does that apply to me? It's like, don't worry, Mr. and Mr. Client, we got your back. Let's just take care of that for you.
Nice. That's awesome. Well, I hope that this vlog kind of summed up everything for you guys with regards to interest rate. I think we covered a lot of things: fixed interest rate, variable interest rate. We went over terms. We went over pre-approvals, what happens if the rate changes during those pre-approvals. And it can be a lot of stuff, and it can be very overwhelming, even though we're trying to put it into basic terms. You know, these things aren't the easiest, and so feel free to reach out to us anytime. Again, my name is Mariko Berg, and I'm a realtor with Preapproval Real Estate Group. Jon Chan, RBC, is the expert. He can talk to you for hours about all things interest rates, terms. We didn't even get into amortization, so that's another one. But yeah, we're here for you if you guys need it, and hopefully this was helpful. If you're looking for a pre-approval or you're looking to purchase anytime soon, just give us a shout. But thanks so much for joining me today, Jon, and I will see you on the next vlog.
Thanks for having me.
See ya.